Thursday, June 11th, 2020, Maneco 64, home of alternative economics and contrarian views. So the Fed's dovishness has spooked the markets. That might sound counterintuitive, but sometimes markets prefer if central bankers give a more positive message, I would say, on the economy. And I think Jay Powell, by trying to placate the markets about interest rates, has actually maybe triggered some kind of profit taking, or maybe it's just time for the markets to turn after the big rebound we've seen since the crash in March. I think it's a bit of both. I've spoken about the cycles, comparing the cycles from 1929 to 2020. I did a video at the end of March saying that the current cycle is much faster, I would say, than the 1929-1930 cycle. Just because of how fast the crash was this year. It was the fastest drop ever in the stock market, at least for the last 120 years or so. And I extrapolated that we could see a rebound for about 13 weeks from the low on March 23rd. And those 13 weeks end in about 10 days from today. Of course, markets are not perfect, of course. In terms of price, I try to extrapolate the percentage move from 1929 to 1930. And I got to around 24,000, and I was wrong about that, and I admit it. We saw the NASDAQ composite make a new all-time high yesterday, I think, which is pretty amazing, I would say, up above 10,000. So that's where we are. I think markets, of course, there are discounting mechanisms. We also hearing of a lot of retail investors getting involved in the markets. The fact that 100,000 new retail accounts have been opened, that is concerning, I think. We've seen ratios like the put-call ratio be at all-time lows almost. I saw an article about Google searches related to call option that they've gone through the roof. So you've got a lot of amateurs, a lot of people who are not professional trying to get involved in the markets. I personally even got a message from my nephew in Switzerland yesterday about trading. He asked me, what do you think about trading apps and ETFs? And I replied to him, you need to be careful about these two. And I said, maybe try to get a proper stockbroker who you can talk to. But at the same time, I said those are rare breeds these days, if you can get them. So all these signals are a little bit worrying. I saw Charles Nenner as well has the same or similar cycle that I worked out. And I don't subscribe to him, but I listen to him on Greg Hunter's, and he's got a cycle top for the stock market more towards the end of this month. So mine is towards, I would say, the end of next week. So what exactly do I think Jay Powell said that spooked the markets? Well, he said something to the effect that the Fed is not even thinking about raising interest rates. And so the markets took that to mean that rates would be near zero for another 2 years or even more. The other thing he said, we are not looking to achieve a particular level of any asset prices. What we want is investors to be pricing in risk like markets are supposed to do. That's pretty hypocritical. If you wanted markets to price in risk, you wouldn't intervene in markets, Mr. Powell. So yesterday the markets did drop. The NASDAQ was up, of course, but the Dow was down about 1%, 280 points. S&P was down 0.5% or 17 points. And this morning, right now, it's 8:30 a.m. London. The Dow futures is down 530 points. It's been down as much as 600 points. So it's down 2% right now. We saw precious metals do very well yesterday. Gold got up to around 1740. This morning, gold has given up some of its gains. It's at 1734.80, down about 0.25%. Low has been 1726, the high 1740. Silver is down about 1% at 1790 or down 18 cents. S&P future is down 51 points or 1.6%. And the NASDAQ 100 future is down 1.1% at 99.68. Currencies fairly steady with the exception of sterling. And I think the British pound is closely related to the health of the stock market, not just the FTSE, but the world stock markets in general, because the financial system worldwide, the city of London, is very important to the pound. So right now, sterling is down 70 pips or over 0.5% at 126.78. The euro is pretty much unchanged at 113.67, and the dollar is down 0.1% versus the yen at 106.98. Crude oil is down 3.5%. The WTI crude at 38.30. 10-year yield, not surprisingly, I told you they wouldn't let yields go back above 1% in the 10-year. And lo and behold, we're down 5 basis points right now, right around 0.7 or 70 basis points. So the other thing I would like to point out is the U.S. debt clock. We've just gone over $26 trillion in U.S. national debt. The debt to GDP ratio right now is 130.46. One thing I've noticed on the U.S. gross domestic product counter, that is now moving up. This, of course, is provided by the Congressional Budget Office data. So it looks like they've readjusted now for the GDP to start growing again. Up until a few days ago, that counter was going down. So that's something interesting to keep an eye on the U.S. debt clock. And I've noticed as well for 2024, the forecast for GDP it's actually gone back up to almost 27 trillion. So we need to keep an eye on these things to see if they change. I think they will change again. They're seeing debt to GDP ratio at 173% of GDP in 2024. So what's my conclusion for today? Well, my conclusion is that people need to be very careful about getting involved in the stock market. As I've said before, you need to think of stocks as owning a fraction of a company. And with anything in life, if you're going to commit to something, you need to know about the commitment you're going to make. You need to do your homework. You need to learn about how to value companies. You shouldn't just go out there and buy a stock, Tesla, that got above 1,000, I think, yesterday, just because it's going up. You need to look at the prospects of the company and the prospects for the economy as well before you make a decision. Be cautious out there. What about me? What am I looking to do? This is not advice. Well, I'm seriously thinking of getting back into the options market. And why is that? Well, because I think there's opportunities. If the markets are going to turn lower, opportunities in put options or call options, even call options on the VIX, right? I did quite well back in February and March with options on the SPX, put options and calls on the VIX. And I'm going to start keeping an eye on it. We'll have to see. It's not set in stone, but then again, I've known about options for over 30 years. I did courses on options. I used to be an options salesperson or broker in the city of London. Options, futures and options. So I know everything about those instruments. And I can tell you another trouble you might face if markets get disorderly again like they did in February and March is that you might not be able to close out your positions. I remember very well this year that some of my positions I had to wait until the limit down in the markets were removed. I'm not trying to put people off like my nephew or any one out there from doing what they want to do, but I'm just warning you that you need to do your homework. Opportunities always arise. Don't think this is the last opportunity to make money in the market. But before you dip your toes into the water, make sure you know what you're doing before you dive in. You don't want to drown in these markets because it's very easy to do. So there you go. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.